Hey, what's up, guys? It's Jonathan here. So, welcome to another live stream. So, in this live stream, I want to talk about the stock market and some more inflation data that we just recently got. So, let's start off with looking at what the market did today, because it was a pretty interesting day in the market. Let me see here. There we go. Let's do this. Perfect. So, pretty interesting day today. The market was mostly red for the day. We did have some pretty big drops in names like Carvana, which was down 12%. Um, they're a company that have kind of been on this like death spiral, mostly due to used car shortage, and now we're starting to see reduced demand for used cars in general. So so they're really suffering right now. We have Cloudflare, which was almost 11% today. A company like Cloudflare and even CrowdStrike, for that matter, they're very prone to interest rate movements. And we did get some data today that did cause the bond market to freak out a bit, but we'll get into that later. We have Open Door, which was down almost 10% today. With Open Door, one of the interesting things with them is that they're actually rumored right now to be looking for a fusion of capital, which I mean you could tell by their stock here, which is at about $1.50. They can't really go out to the open market to raise capital anymore. And this company, honestly, is probably on its way to bankruptcy. Their business model was pretty much solely flipping, and I believe they had an arm that also worked with mortgages as well. Well, obviously, we all know that the mortgage industry has collapsed since interest rates have gone from like 2.5% to I think now they're like almost 7%. So that hasn't really worked out well. Obviously, because real estate prices are softening under the pressure of higher interest rates, their flipping business, which is their main like way to make money, is also collapsing as well. So it's not good times out there for them. And this will be a company that'll be interesting to see kind of where it goes from here. But really, I think they're on their way to bankruptcy. So that's just my opinion on it, not financial advice. So um, there's Snowflake. Again, Snowflake is kind of in the same crowd as Cloudflare. They're both two companies that ain't that they're very sensitive to interest rate movements. They're companies that are expected to be very profitable in the future, but currently aren't. And um, but the hope is that the hope is that in the future they will become very profitable because they sell software as a service, which doesn't require too much cost to administer the service. So DocuSign's in that same boat as well. Um, AMC did take a beating a bit. I'm sorry for the apes out there, but with AMC, they're a very debt heavy company. So anytime we hear about interest rates moving, especially up, doesn't help the story for AMC, especially given that the fact that I believe they pay more money in interest to service their debt than they make in revenue. So it's not so higher rates is kind of what they don't want right now, and obviously the market showed that they don't want that either. Seeing a lot of pain in the crypto miners, Hut 8 and Marathon. What else here is pretty interesting? Um, yeah, it was just overall just a very red day. Trying to see where Tesla is. Here we go. Tesla was down six and a third for the day. One of the things about Tesla that was really interesting to me is the fact. Well, one the news that we got with Tesla today was that Tesla actually um, there was reports that the production in the Tesla factory was down for is going to be reduced, and that is creating a lot of concerns about the growth story behind Tesla and their ability to be able to grow their manufacturing. There's a lot of thinking that that's really just concentrated to the fact that demand in China is down because of the economic um, recession, or you could even call it depression, that they're going through right now. But and hopefully that's not the same case that we're seeing in America. But I think we're gonna have to kind of see how that plays out, and if we do hear about more slowdowns at Tesla factories, whether that's Berlin or Austin or Fremont or anything like that. So that was pretty interesting. Um, Kathy's arc is still bleeding out. Hasn't been a pretty year for them. What else do we have here? That's pretty interesting. Um, yeah, it was just an overall not a great day really for stocks. Let's see what was green here. We have we have SARK, which is just the short of ARK. So obviously that was green because ARK was down today. Wow, Taiwan Semiconductor actually finished flat for the day. I believe they were up for most of the day, then they're down for a little bit, then they came back up again. Um, Bed Bath Beyond was up. What else here is noteworthy? Beachbody was up. Um, I do remember back when it was gosh, what was it? It was a SPAC. I remember when it was at like $10, and now it's at like 71 cents. It's absolutely crazy what's happened to those SPAC companies. That a lot of those SPAC companies were very overvalued, so it does make sense that we are seeing some softness with them, especially given the fact that a lot of these companies just weren't very like great companies, honestly. Like I don't know, like Beachbody, like the growth behind Beachbody is like pretty much done. Like they've been around forever, so it's a little interesting. But anyways, um, yeah, so that's pretty much it. So let's get into talking about the how the market today and some other news that happened. So overall, the stock market was down mostly due to the ISM report that we got today, the ISM service report that we got today, and this pretty much caused all sectors of the market to sell off. Like I said, Tesla was down 6.5% off of reports of lower production at their Shanghai factory. Treasuries did move up to 3.6%, which again, like I said, when treasuries move up and the cost of money becomes more expensive, highly indebted companies tend to take that to chin the worst. So companies like AMC or Cloudflare or a lot of those very high valued, highly indebted tech companies. So now the market has, because of the strong ISM report that we got, which is not good for inflation, the market did readjust the expected Fed terminal rate. Before, the market was looking at about a 5% terminal rate. Now the market is looking at the terminal rate being about 5.25. So the way the market's pricing it in is that they're pretty much pricing in another 25 basis point hike in, I believe, May. Um, after, because there's February, then there's March meeting. So there's December, which is expected to be 50. Then there's February 1st, which is expected to be 25. Then March is expected to be another 25. Then in May there would be another 25, and then the ideal is that the Fed would stop hiking at that point. So um, the Morgan Stanley strategist Michael Wilson actually came out today, and previously he had stated that he was very bullish on a on a rally that would last throughout all of December. But now he has recently changed his opinion and has said that he's actually taken a strong selling stance now, mostly based off of the strong jobs and ISM report that we've gotten over the past week. And this is pretty much suggesting that the suits should wait on the sidelines and see what happens with the PPI and CPI report and what the Fed says before they go back into the market. And um, there also is a lot of concern from this strategist that there will be down pressure on stocks in January under the pressure of reduced corporate profits. That has a lot of basis behind the fact that there is strong belief that we will go through a mild recession at some point in 2023, and that the reduced guidances and reduced EPS will cause downward pressure on the stock market as a whole. And JPM actually echoes this opinion as well. They believe that there will be a sharp decline in stocks in the first half of 2023. Again, mostly due to the possibility of recession, and also to a more aggressive Fed, the possibility of a more aggressive Fed with hiking rates. But they do expect that the Fed will pivot in the second half of the year, and that'll fuel a rally in the stock market. But but we'll have to kind of see how that plays out. So we got so on Friday we are expecting to get the PPI data, producer price index, and remember that's the Fed's favorite way of judging inflation. They usually like to use that data over CPI, but they have stated that they do consider both reports. That this expectation of this data is causing some hesitation from from some investors and is keeping them on the sideline. So it is very most likely this week we will get very low volume, which would mean that we will have a very volatile stock market, and most likely it'll be volatile in the down direction. Um, and that will be one of the last, and the PPI will be one of the last pieces of data that the Federal Reserve has before the FOMC meeting. I believe they will get the CPI right before they start their meeting on the 14th. Actually no, CPI comes out on 13th, so they will have those two pieces of data, and I think that those two datas will be very those two reports will be very important to determine what the Fed does next. So, like I said, markets are most likely going to stay volatile, and another thing that was mentioned today as well was that the MLIV pulse survey was taken, and about 28% of survey respondents said that they expect defaults in corporations to jump in 2023 if the Federal Reserve raises rates above 5%, which, like I just said, the market right now is currently pricing in a 5.25 terminal rate for the Fed. So there is a lot of skepticism that we may see a lot more corporate defaults in 2023 if we do see this aggressive rate hike continue. And this will be something that will be very interesting. We did have FTX just file for bankruptcy. We're not sure yet if that was because of too much debt or if that was because of fraud. We're gonna have to see that, but I do expect that there will be a lot of pressure, especially on very highly indebted firms, where we will see more defaults in those kind of companies. So it's something that like I'm actually personally trying to invest away from. I don't want to be involved in companies that have a lot of debt. I don't want to be involved in companies that don't have enough revenue to even cover their debt or to cover all their expenses and their debt. I want to stay with companies that have margin, especially in a market like this. So, um, some important events happening this week. Like I mentioned, we do have the PPI report on Friday. We also have the University of Michigan Consumer Sentiment report on Friday as well. That will give us a good take on what consumers expect, what consumers 1 year target inflation rate is, which is really good to kind of tell like where the consumer is at right now. On Wednesday, we're supposed to get the U.S. MBA mortgage application data. That'll be very interesting to see kind of how the mortgage industry is moving right now. And then on Thursday, we will get the initial jobless claims, the U.S. initial jobless claims. So that'll be interesting to see as well to um, compare it to some of the jobs data that we got. So the other thing I wanted to talk about was the ISM service report in more detail. So let's set this up properly. Let me. Okay, so let's do this. Hey, what's up, guys? It's Jonathan here. So we just got the ISM. So just today, we got the ISM Institute for Supply Management service report, and the results that we got was not very good. So let's get into it. So pretty much what the ISM report measures is the change in the ISM service report. What it measures is the change in service business activity. And this is very similar to the ISM manufacturing report that measures a change in manufacturing business activities. And the best way to think about it is that obviously in the economy you can either sell goods or you can sell services. Well, this report covers services, but then the manufacturing report you can pretty much think about it as serving goods because obviously you have to manufacture a good. Like it's a something that you're actually like selling someone. But anyways, the results that we got for the month of November was the index came in at 56.5, which when it was expected to come in at 53.3, so it came in a little hot. It was up from 54.4 in October, and this is actually the biggest jump that we've seen since March of 2021 in this data. So this report is moving in a very opposite direction from the ISM manufacturing data, which showed a slowdown in factory activity. And not only did it show a slowdown in manufacturing activity, but also showed a slowdown in in spending of goods. And this was mostly the slowdown in manufacturing was caused by excess inventories from various firms, which we have all kind of heard about. If you've been if you listen to the last like Target or Walmart earnings, you do hear these companies talk about how they have so much inventory and they're having a difficult time moving a lot of the inventory that they have. This was mostly due to the fact that they overordered back in 2021, and now because they overordered and now the demand for goods is slowing down, they kind of got trapped with all this inventory. But anyways, some of the service industries that did grow during the month of November was surprisingly real estate actually grew. And this I thought was a little interesting because when we look at data from whether it's the Redfin data center or a lot of the mortgage and price data we've gotten, we actually see that transactions are down and prices are starting to fall. Unfortunately, I read through the report and it didn't really seem like they gave an explanation to why the real estate industry was growing in November. So I'm really curious to know kind of where they got their data and what maybe they might categorize real estate differently than I do, but that was really interesting industry I saw. Some other big growers, some other industries that did well in November as well was mining, agriculture, forestry, and fishing and hunting. And most of these industries reported strong demand or demand that matched pre-COVID levels. So the report did mention when it comes to business activities in the service industry, it did mention grow. It is grow. Not only is it growing, but it's growing faster than ever before. And when it comes to new orders, this is and when it comes to new orders, New orders have eased to the lowest level since May, but and it is still growing, but it's just growing at a slower rate than it did before. And this indicates that we are seeing some softening when it comes to firms ordering more. Firms ordering more services, which again I think plays into the fact that there is too much inventory at some of these firms, and that some of these firms and a lot of these firms' businesses are starting to slow down. So there isn't that need to keep ordering at the very high pace that they have before, even in the service side of the market. When it comes to employment, it is growing. That it is growing at a very rapid rate. This is in line with a lot of what we've seen with these job reports that we've covered over the past week or so. We saw that in the government job report. We saw that in the ADP job report, the private payroll reports. So it seems like we're still getting that same data. Um, when it comes to supply deliveries, it is growing at a slower rate. Again, probably due to excess inventories at firms. And the price paid index is actually still pretty elevated at 70. This does show strong signs of strong demand in the service industry. But they did mention that they are seeing a slower rate of increase than they did before. Now, I think that pretty much I think that most of this data does line up to what we saw in the jobs data when it comes to both the government and the ADP report. I do question some of the results they got, especially the strength that they mentioned in the real estate market. That hasn't been what I've seen, at least, especially nationwide, not only just in certain markets. I've actually seen real estate slow down quite a bit. Have friends who are in the real estate industry, and I've had them tell me multiple times that they've had listings canceled before they even had an open house. So I'm really question how they got that data, but hey, I'll just let that be for now. So obviously, this report, because it did come in so hot, it did scare the market a bit. That we may get a high producer price index and CPI reading, both on Friday and I believe next Tuesday, respectively. So that is causing some concern in the markets. But I think for the most part, um, this report doesn't necessarily matter as much, and that what's really going to matter it doesn't matter as much when it comes to what the Fed is looking at. I think the Fed is going to be much more concerned with what they see on the PPI and CPI reports. Um, Personally, again, like I am a financial advisor, I'm a licensed financial advisor and everything, but I cannot give you personal financial advice. And this is very impersonal financial advice and just kind of where I'm at with things. But personally, I do see, I am more of a fan of waiting to buy after we get some of these reports like the PPI and CPI report, and maybe even after the FOMC speaks. At their press conference, because I think right now that it's much better to just wait till we get certainty than to just jump the gun and try to buy with the hopes that we will get a dovish Fed or we will get a dovish report. But for me personally as well, I'm also mostly already in the market, so the consequence is very low if we do get a dovish report and the market starts to move up on it. But that's basically all I got for you guys today. Thank you so much for watching. I'll see you in the next one. Peace. All right. That was great. So, you know, Monday's very slow news day, but that's basically all I got for you guys on the live stream. Thank you so much for joining me today, as always. I appreciate you guys coming out. If you're not subscribed, please subscribe to the channel. I try to post here as much as possible, try to keep you guys updated on what I'm seeing in the markets and kind of what I'm reading up on. And that's basically all I got. See you guys in the next one. Peace.